impact. Now, without any further delay, I would like to introduce our wonderful speaker for tonight's session, Zara Qureshi. Zara works with changemakers and founders to support their passion for positive impact on people, communities, and the planet. She is a chartered professional accountant who is committed to doing business with heart. She launched Optimum Professional Cooperation with a mission to reduce the overwhelm and stress caused by accounting systems, finance concept, and impact planning tools. As a coach and consultant, Zara brings over 12 years of experience to help entrepreneurs and change makers build confidence and strategic clarity for achieving financial sustainability, powerful growth, and positive social change. Zara shares her passion and knowledge through workshops and mentorship at 15 plus entrepreneurship programs across Canada, covering topics such as accounting basics for new founders, financial empowerment, creating an impactful blueprint, and the United Nations Sustainable Development Goals. Zara, it's a pleasure having you here to facilitate this workshop, and I welcome you to begin the session.
Thank you, Alina. That was a wonderful introduction. I'm going to start by sharing my screen. There we go. Thank you. I'm keeping an eye on the chat. Alina is going to be helping me with that as well. So we're going to be going through quite a few topics. I encourage you to pop in your questions as they come through. That'll just be easier, anything more valuable for everyone. So I'm going to skip my introduction. I will say I am a proud Ella graduate through Y-Space, and that was an amazing experience, so highly recommended. But Alina covered everything else here for my intro. So a brief overview of what we're going to be going through today. I'm going to be introducing the accounting process in kind of 5 key steps that it's broken down into to highlight what kind of things you need to work on. And then we're going to be looking at the finance and the more entrepreneurial side of things in terms of how you use this information for things like budgeting, reporting to stakeholders. And accounting and finance are really functions that are designed to support your success when they're used well in your business. So hopefully you can take some insights out of the session today on how to build this process and make sure that it does add value for you as an entrepreneur. So diving right in, I always like to just start with a question and be very honest. I've heard it all. Just in a couple of words in the chat, please tell me, how do you feel about finance and accounting? Are you feeling good? Lots of love. Awful. I got an awful in the chat. Yeah. So it can be quite overwhelming, and it really depends on also your comfort level with numbers and financial statements. But hopefully, my goal for the session is to improve that a little bit for you and give you some next steps in terms of how to keep learning and have some procedures on what to do next. I got a 5 out of 10 in the chat. I'll revisit that with you at the end and see where we're at with the rating. Good. So, terribly annoying. So breaking it down very simply, finance really just means it's anything to do with money. And at its very basic, that's what it means. So what is accounting then? So accounting is basically a language that is used to convey financial and non-financial information about businesses, corporations, and how you're doing. So accounting is the language of finance. There are parameters around how to measure, how to process information, and then communicate it to third parties. And using that common language and making sure that everyone's going to understand the reality of what's happening within your business. And that's really the reason for this language to exist, is to have a standard set of concepts that are applied so that you as a manager and an entrepreneur, when you're looking at financial information, you have a very clear understanding when you're communicating to investors, regulators, Canada Revenue Agency. You have those common parameters in terms of how the accounting language works to be able to report accurately. Where does the language comes from? So in terms of the tax side of things, the language comes from the Canada Revenue Agency. If you're working with an accountant, chartered professional accountants like myself, we help you to implement this language, and CPA Ontario, CPA Canada does a lot of work in terms of helping um, to understand and clarify how the language is applied. And the standards that we often use are based on the International Financial Reporting Standards, which basically cover anything under the sun that might happen in your company and the rules that apply to it. And then last, there's specific language or communication that needs to be done in regulated industries. So something to be mindful of depending on what you're doing. If there's any other entities or rules that apply that you need to follow. And Ontario Securities Commission is just an example of that. So we covered this. Why do you need this language? You're going to be using mainly to do taxes for your Canada Revenue Agency. You're going to communicate activity to investors and other stakeholders. You're going to need to have proper accounting and budgeting procedures to be able to secure funding and support. You as management and founders want to be informed of the performance of the company so you can make the best decision possible. And lastly, as a social enterprise myself, and aligning with the United Nations Sustainable Development Goals with a lot of my clients, it also helps you to report on impact, where you're spending money and what kind of benefits it's creating for the community and the environment. So let's take a look at the process. There's 5 key steps that I break it down into. Starting from just business activities taking place in your organization and taking you all the way through to the final reporting and analysis. So what's happening in your company? Think about different business activities and what are examples of some of the activities that are happening in your business. And all the key business activities, they generate documents. So what are these documents that are generated by activities that are happening in your business? Any volunteers to pop some ideas in the chat? Examples of business activities and documents. Anyone?
I can take a guess. Balance sheets.
Yeah, so balance sheets, profit and loss, I see that in the chat. Those are all financial reports that come out of your system. So examples of business activities that happen is revenue when you make money. So when you make a sale and you issue an invoice to a client, when you buy something from a supplier, which are expenses that you spend on, you receive an invoice. I see that one also in the chat. Those are great examples. When you get a new investor, whether that's a loan or equity, the documents that you sign, which represent, what they're getting and how much money they're providing you, those are all examples of documents that represent activities happening in your organization. When you do payroll, you generate pay stubs for employees. So really everything you do, there really is a paper trail that you have to save and retain within your business. So who takes care of these steps? These steps are actually the responsibility of every person in the company that's involved in the activities. So if you have a salesperson that's confirming what a customer wants to buy and they're confirming the transactions, it's their job to make sure that that's being communicated properly and that an invoice is being generated and saved in your internal records. If you have an operations manager that's buying something from a supplier, that person needs to make sure that they're getting an invoice, they're getting the proper information for whatever purchase is being made, keeping your receipts from your credit cards, all that stuff. Whoever is doing those transactions and for the business needs to make sure that those documents are saved and communicated to an accounting department. For you, that might be just kind of keeping it in one spot on the side of your desk. But it's very important to keep receipts. As long as you have the accounting records and that information, you can go back and create financial statements and review the performance. If you don't keep these records, it's very hard to go back and chase down receipts and collect them. Some of them you might not be able to at all. So very, very important to maintain this information and all the receipts. So in terms of day-to-day book record keeping, what do these documents look like? So there's a couple of parameters that I've highlighted. The documents should have a date of activity. When did this happen? So if you had new shareholders come in or you got a loan, any revenue or expenses, there's a particular date attached to when that activity happened. Was there a movement of money associated with it? It should clarify that. Is money coming into the organization? What is it for? Maybe they bought 2 products from you. It should articulate that. And if money is going out, it should also highlight same thing, how much is owed and what is it that you're paying for. So in addition to keeping this information for accounting records, it's also very important for tracking payments and managing cash flows. So especially as a startup, watching cash very carefully is a big priority. Having these documents in the right place, you can track and plan what you spend your money on. So what happens to these documents? They are processed in your accounting system alongside your bank statements and credit cards. So your bank statements and your credit cards show how money is flowing in and out of your organization, and all these documents can corroborate, and you can figure out what is revenue from customers, expenses from suppliers, and other forms of money coming in and out of your organization. I see a question in the chat. If you are a business owner, do you need to file for payment of salary to yourself as an employee, same as you would with any employee? That's a good question. So if you're a sole proprietorship, everything that happens in the business belongs to you. In that case, you don't consider yourself an employee. As a corporate, if you have a corporation, you can establish your relationship with your corporation as an employee. So as all these transactions are processed, the accounting system, once it's set up, it gets compiled into statements. Statements are based on a chart of accounts, and we're going to be looking at them a little bit closer to identify the different parts of the financial statements and what stakeholders might be looking for. But all the documents are processed to reflect how much income and expenses you have, what assets are there that your company owns. Question in the chat. Yes, so with a corporation, you can be an employee, but you don't pay EI. EI is optional as a self-employed person. If you want to pay and access the benefits, you can apply for it, but you don't have to. Okay, so options for accounting system. As a small business, if you have a really organized Excel spreadsheet, that can be a good accounting system. It depends on your comfort level. I've had some businesses come and they say, my accounting system is not organized. All I have is an Excel spreadsheet. And I found that, their Excel spreadsheet had all the details, like I mentioned, the date of the activity, what was a transaction for, the amount, all the information was there, and it was organized really well. So it's more about that, even with an accounting system, to keep it clean and well organized. And you can find what's best fit for you. Wave and QuickBooks are the ones that I use most often. Xero and FreshBooks are also very common for small businesses. Sage and SAP are for larger businesses. SAP is a huge system. I just put it there as an example to kind of see comparable. So for very large organizations, it's a very complex system that they can use to manage all their needs. But if you're looking for something to start with, Wave and QuickBooks are both very good. Wave is free to use for basic accounting. So if you want to even just start to get a flavor for what it's like, you can set up an account there and browse through what the statements and transactions look like. I did want to give you a bit of a glimpse. So this is what an invoice document looks like if you're entering an expense. And this particular screenshot is from Wave. And it asks for all the information that we've kind of gone through. So who's the third party that your transaction's happening with, in which case a vendor or supplier, the date on which the transaction happened. Um, Invoices should have a unique document number most of the time, whether you're issuing or receiving invoices. So there's space to input that. And then there's space here for you to provide information on what it is that you purchased, what expense account do you want to put it to, how much did you pay for it, and if there was any tax associated with that. So fairly simple to follow, and all this information should be on a receipt. If you're working with a supplier and they're missing part of this information, you can actually go back and ask them for it, which is perfectly reasonable. The other thing that you see a lot in accounting software is that you can upload your bank statements and then just go transaction by transaction and tell them, okay, what is this for? So this is an example of when I uploaded my bank statement. It told me that on October 29th, I had a transaction come through from my bank account, which says monthly plan fee, and it's for $19. So for me, I know that that's what the bank charges me every month to have my bank account. And then what I can do is I can just choose, okay, if that's the expense that I want to put that to bank service charges, and just accept it as a legitimate transaction. So that's another way to account for things. And accounting software has tried to make that as easy as possible if you want to do it yourself as well. So once all these transactions have been processed, your accounting system will be set up to generate financial statements. And the two main financial statements that you're going to be looking to get out of your accounting system are the balance sheet and income statement. Basically, the language, the standardized language of accounting that we were talking about earlier, it makes sure that all your stakeholders are going to be able to understand these documents and what they say about the activities happening within your business. So first and foremost is the balance sheet. So the balance sheet, think of it like taking a picture that you get to see what is happening, what is in the organization as of one particular moment. And what that shows is it's represented by an equation called assets equals liabilities plus owner's equity. Essentially, what that means is that everything that your business has is in its possession minus what it owes to other people. The difference between those two things is your owner's equity. It's the value that you own at the end, after everything that you owe other people is paid off. This is an accounting measure. It's not a measure of market value. So if your owner's equity says 100,000 in your accounting records, that doesn't mean that you'd be able to sell the business for 100,000. Accounting doesn't factor into a lot of things that bring value to your business, your customer relationships, your partnerships that you've built, future orders that you're expecting to get, or innovations that you've put together. It doesn't really reflect all that value that exists in your business. The good thing is that accounting software is programmed to automatically make this equation always balance. So you never have to worry about the math working out. That will be done for you in the back end if you process all the transactions. So when you look at a balance sheet, under assets, you have current and non-current. Current assets are ones that cycle through your business, and they're going to be in the business for less than a year. So you have cash in your business that you spend on suppliers, then you get more from customers. It should ideally be cycling in and out to keep your business running. That's why it's considered a current or short-term asset, and same with inventory. Non-current assets are ones that are expected to be in your business and in use for more than a year. So that's machinery and equipment. If you own a building and maybe that's where your products are produced, or you have office space where your employees are, that's going to be around by their nature in your business for a long time. So you report them as non-current assets. An opportunity with non-current assets, for example, is that if they can be used for collateral. If you have machinery or equipment They can be used to show that you have value in your business, you have established a space to be able to produce your products and services. So it's important to distinguish between current and non-current. Then you have liabilities. So liabilities are anything that you owe to stakeholders or investors. Similar to assets, it's divided up between current or short-term and non-current. So current or short-term liabilities that are going to go through your business pretty quickly are one, accounts payable. So when you owe money to suppliers or vendors, any taxes that you owe to the CRA, those would all be pretty short term. Deferred revenue is another example. If you've collected money from customers but have not delivered the product to them yet, that's an example of deferred revenue, and that's considered a liability because you owe the customer the product or service still in the future. Non-current liabilities or long-term liabilities that are going to be in your business for more than a year generally are loan or debt arrangements with new stakeholders, funds that you've brought in to be able to run or expand your business that don't need to be paid back within the next year. And then lastly, under owner's equity, you will disclose the value of any shares that you've issued to the business, common shares, preferred common shares. And then you have retained earnings. So retained earnings is a running total of all the profit and loss that has gone through your business, that goes through your income statement every year. And as an owner, you can pay yourself dividends, which would also be reflected as a payment out of owner's equity. So in terms of balance sheet, when you use the accounting software to do all your entries, that's something that will be produced for you. You just have to be mindful to create the right account. So you have an account for your bank, you have an account for accounts payable or particular loans that you have, a shareholder loan account, whatever you need, just being mindful that you're creating it in the right category. And then being able to look at and analyze some things like, you don't have enough cash to cover your upcoming accounts payable. Balance sheet can help you distinguish things like that as well for the purposes of business management. Then you have income statement. I expect everyone's a little bit more familiar with this. So an income statement tells you the story of what's happened within the business over a period of time. Officially, that's generally reported on an annual basis. But as a founder, for example, I look at my P&L statement quarterly or monthly to analyze how things are going. And that helps me to make decisions in the future on managing the profitability of my business. So the key components of an income statement, you start with revenue. So that's what you get to collect from the sale of your products and services. And then right below that, you have your direct costs. Direct costs are the costs that you incur in the process of creating and getting your product or service ready for delivery. So if you're buying raw materials, if you're paying a subcontractor to get work done for your client, if you are delivering the product to the client, all of those are directly related to getting your product or service to the customer. So those are considered direct costs. Revenue minus direct costs gives you gross profit. This is something, gross profit is something to monitor closely to make sure that it's strong. You can find industry benchmarks for gross profit if you do research online for your particular industry. And if gross profit is negative, that means it's costing you more to just produce your product or service than you're able to sell it for. Then below gross profit, you have indirect costs. So indirect costs are everything else that you need to do to run the business. So that's insurance, legal, accounting, office and admin, all those things go into indirect costs. And those are costs that are, while they may be essential to running your business, they don't help you to actually produce your product or service. So then gross profit minus indirect costs gives you operating income. And then below operating income, you have what are called finance costs, which most common example of that is interest expense that you have to pay on a loan. Um, that's generally the most common example, and that gives you your net income before taxes. If your net income is positive or not a loss, then you're going to be paying taxes on it, which is the bottom line there. And that brings you to your final net income amount. Any questions so far?
So I do see one question. Would you be able to post the content of us to reference?
Are you looking for further details on anything that's in the slides? I definitely can provide you with further reference or reading material.
Is that what you were asking?
Or do you just mean the slide deck itself?
All right, I can take that offline also, Zara. Nikki's asking finance costs are interest, bank fees.
Yeah, so finance costs are the costs that are associated with trying to get funding for your business. So when you're trying to get loan or equity, whatever costs you incur in that process of bringing money into the business. So yes. Okay. So jumping ahead to cash flow statement. So cash flow statement is it tells a story of your business over a period of time. So very similar to the income statement. The big difference between them being is that an income statement reports income and expenses and the performance of your business on what is called an accrual basis. And I'll explain a little bit more about what that means. A cash flow statement literally shows you how money is moving through your business. And it can help to highlight how you're using your money and if there's concerns around running out of it or not having enough money. And there's three buckets of cash flows that's divided up into. So the first is operating, which includes your money received from clients, money paid for expenses. So it includes your cash flow associated with revenue, direct costs, indirect costs. The difference between this and an income statement being if your client hasn't paid you, that would not reflect an operating cash flow, that would negatively impact it. Sustainability, when you're looking at the concept of financial sustainability for your business, having consistent positive operating cash flows would be an important metric to look at to set goals for that. Then you have investing expenses. So investing expenses are capital expenditures or asset purchases that you've made for your business. So investments that you've made in the long-term or non-current assets of your business to be able to produce, to expand capacity, to innovate. Those all go under investing. As a growing business, you will have a lot of investing expenditures. You might be putting a lot of money into investing to be able to set your business up for future growth. There's no right or wrong answer in terms of what your investing cash flow should be. It really has to line up with the story of the stage at which your business is. Same with financing cash flows. So financing cash flows are related to the capital structure of your business, how you funded it. Did you issue shares? Do you pay dividends? Did you get debt or a grant? So it shows how money is coming into your business and when you have to pay it back. As an early stage high growth business, I would expect to see that you are bringing in a lot of financing cash flows to invest in your business and its operations to expand capacity. And I would expect that to translate into higher profitability in the long term. So that's a little bit of information on the story that cash flow statement tells you. So as I mentioned, the difference between an income statement and a cash flow statement is It's really a difference of timing because when activities happen in your business is not the same time when cash actually moves through your business. So an income statement works on what's called an accrual basis. It will consider, for example, if you issue an invoice to if a supplier gives you an invoice, it would consider that on the date of the invoice. But a cash flow statement recognizes that only when it gets paid, when the cash is moving through your business. So just for clarity, I've given a few examples here in terms of the difference between cash flow and accrual. So the first one is that you sell tickets for a concert or an event, and revenue is earned only when the event takes place. So on a cash flow basis, you sold tickets in November, December. It's great. You've got the money in the bank. But from an accounting perspective, you don't earn that revenue until, let's say, that event takes place in February. So you're going to be recognizing that revenue only in February. Another example is when you buy from a supplier today, but a supplier tells you that you have 60 days to pay. You've made the purchase, you've gotten the supplies, so that's your expense today, but your cash flow is not going to happen until 60 days later. Other examples are employee bonuses between when they're awarded, and let's say, your December Christmas bonus, but it gets paid later. And then the last example of that is when you buy equipment or a large asset, what you do is you depreciate it over time. So let's say you have spent $10,000 on an asset and it's going to be in your business for 5 years. You expense it over time. So you would recognize $2,000 every year in your income statement to show that it's being used over time to generate the revenue in your business. But from a cash flow perspective, you would show that you've made that investment on day one when you spend that $10,000 and get the asset. So those
Sorry,
are,
sorry. You can finish your sentence and then.
I was just going to say those are the most common examples on the difference between cash and accrual.
Perfect. Celia's asking a question in the chat. Is there a difference in terms of taxes if you pay yourself a salary from your corporation versus keeping that amount as the profit of the corporation?
Yes, there is a difference. The corporate and personal tax rates are different. What those actual tax rates are would depend on your situation. So I can say yes, but that's all I can provide because I have to look at the details on what goes through your personal and corporation to tell you what the tax rates would be.
Great, thank you.
Okay, so types of financial statements. So when you're looking at your balance sheet and income statement, depending on the needs and goals you have for your organization, you are probably not going to be too worried about providing formal financial statements. For small businesses, notice to reader financials are sufficient, and that's where an accountant will come and do a high-level review to help you correct and compile and produce properly formatted balance sheet and income statement with a letter attached that they've compiled them for you. And these can be done by a CPA firm. As you move up the arrow, you can get a review engagement or audited financial statements. At each level, they're more work, more expensive. Usually you pursue if you have a stakeholder that requires it. So CRA can choose to audit you themselves, but usually if you have potential investors, a grantor, or a lender, they may require you to get reviewed or audited statements for their assurance. So just something to be mindful of. But for a lot of entrepreneurs, notice to reader financials are a good start. So, this is a fun part that I like. So the reason that you do all this work is to be able to use this information to run your business, to share with your stakeholders. So we're going to be talking about all those good reasons. The first one is keeping your key stakeholders happy. Your first and foremost stakeholder is going to be Canada Revenue Agency. I know we've been talking about tax a little bit already. This is everyone's stakeholder, personal, corporate, no matter kind of what you're doing. CRA is something that you're going to have to deal with. So just make sure that you set it up correctly right off the bat. If you don't, it can actually get pretty expensive to clean up your record and catch up with the CRA. There's 3 types of relationships that you can have with the CRA that I'll go through today for entrepreneurs. The first is income tax. So income tax is where you have to pay taxes on the profits that are generated by your business. A T1 filing that's done annually, it's due April 30th. That you have to do as a person, no matter what. You're always supposed to do it. If you have a sole proprietorship, there's additional forms that you include to disclose that you're running a business, and you report the revenue and the profits from that business, and that you own and manage that. Then you have what's called a T2. So if you're incorporated, CRA considers the corporation to be a separate person with its own tax filing obligations. It's just as a representative of the corporation, you're going to be the one that's held responsible on behalf of the corporation to file. And that's called a T2 form. So that's a completely separate set of forms that are due annually 6 months after your year end. And for that, you need to have a balance sheet and an income statement to be able to report on the filings. A T2 is something that's done for for-profits as well as nonprofits. Nonprofits would be tax exempt, so for them it would be reporting only. And then for for-profits, you would get your taxes payable amount. If you have a profit and taxes payable, you would have to pay that. Charities have completely separate filing rules. I'm not going to get into too much detail. That can be quite complex, but their reporting is completely different. So then after income tax, you have sales tax. So sales tax, if you've purchased anything in Ontario, you would be familiar with that HST that pops up on your receipts that you pay. So for sales tax, the threshold to register for it is if you have 30,000 in revenue, in taxable revenue over 4 consecutive quarters. If that happens, you're required to register and charge HST. If you haven't met that requirement yet, you can still register. Once you register, you have to collect HST. So you can't do it that you register and then not charge. That you're not allowed to do. So once you're registered, whether voluntarily or it's required, you have to charge HST on revenue. And then what you also should do is track HST on everything that you purchase. And then on either a quarterly or an annual basis, as you grow, it might even be monthly, you have to report your sales that you collected HST on, how much HST was paid to you, minus how much HST you paid out on purchases. So you have to remit that amount to the government. HST collected on sales minus HST paid on purchases, reported and paid to the government. The one thing I would say here is check your product or service, learn more about HST. It doesn't apply the same way to all products, and rules are different in depending on where your customer is, where you're operating. So check what are the percentages that would apply to you to charge HST. I see a question in the chat, Jerry. Is it 30 or 40K for HST? It is 30,000 in 4 consecutive quarters. If there was a recent change to 40,000, I don't know, but as far as I'm familiar with it, it is 30,000 is the limit. Okay, so the last type of relationship that you can have with CRA is payroll. So if you have an employee, or if in a corporation, if you yourself are even the employee, you have to register for a payroll account. And And once you register for a payroll account and are paying employees, it's your responsibility to withhold taxes for them, and withhold payments for employment insurance and Canada Pension Plan contributions. As an employer, you also pay a part of, you contribute to their employment insurance and pension plan as well. And then you gather that money and you submit it to the government, and then you pay employees their net pay and give them a pay stub. So you do that on a periodic basis, and then either quarterly or monthly, you would be required to report back to the CRA during this time, how much did you pay to employees, what your gross payroll was, how many people got paid, and then how much did you withhold in tax or insurance, and then you pay that amount to the government. Any payments that you need to do to the CRA, do them on time. They do charge interest or penalties on them if you don't. The other thing I will clarify, both for HST and payroll, those are things that can be set up whether you're a sole proprietorship, for profit, or nonprofit, if it is applicable to you. Are there any questions on CRA? If any of you have employees, there is a deadline coming up to submit your T4s and T4As on February 28th. Yeah. Any questions at all?
I think we're good in the chat. Oh, there's a question. So, do you have to pay the EI taxes, CPP, and everything immediately to the government on payroll dates?
No, you don't. There will be a deadline that when you open your payroll account, or if you already have a payroll account, you can go onto your CRA account and check what the deadline would be. It's usually if it's quarterly or monthly, you'll have 15 days until after month end to process. So for example, let's say I do payroll every 2 weeks and I did it on January 15th and January 31st. I would have 15 days from the end of the month to remit that amount. So you do have some time. And it's the same. So whether you do it monthly or quarterly, you would have some time until after the end of the period to do it. But you would pay your employees on the date or whatever the routine is that you have, whether it's biweekly or monthly. I will say, if you're using a payroll software, which I recommend, unless you feel really comfortable calculating it yourself, that's fine. If you're using a payroll software, they will actually take the money out of your account and process it on the pay date. So that'll be the exception. But what they do is they take the money out of your account on your behalf for the employee's part, for the withholdings and everything on the payroll date, and then they will do the whole remittance and everything to the government on your behalf. But if you're doing it yourself, it's not the same date. I hope that clarified. Okay. Happy to continue to take any questions. What is the cheapest payroll software? Because I use WagePoint, but I felt like it's too much. WagePoint is for everyone's benefit, WagePoint is $20 plus $2 per employee. I found that they're usually around that. I haven't found one that's cheaper yet. I did do a little bit of research, but
yeah,
fairly comparable. Yeah. I know if you, for example, if you get WagePoint through an accountant, you get a 20% discount. That's something that I do with my clients, but that's the only slightly cheaper option that I've come across. They're fairly comparable. Yep. So you can, if you feel comfortable doing the calculation and paying the employee and the government yourself, you can do that. You don't have to use a payroll software. You just have to be mindful of the deadlines and the calculation and where to submit the money. Okay. So, talking about other stakeholders, after Canada Revenue Agency, I've given a little bit of an outline here in terms of different types of investors or funders that you might be working with and why your financials would be important to them. What is it that they're looking for? Um, so, if you're getting a loan and you've received the principal, the expectations from the lender would be that you're going to pay back the loan principal and you're going to pay them back interest, and hopefully you're going to pay it back on time. So when they ask to see your financial history, they're looking to see that you're going to be capable of doing that. They might ask you for future financial projections, pro forma financial statements, which are essentially forward looking estimated balance sheet income statement. They're going to be looking to see, is this business going to generate cash? Have they planned to generate the cash to be able to pay us back the loan? And then you have equity. So equity is ownership of shares in the company. And they want to assess the potential of your business. So is the business going to grow enough that they can sell their shares in the future for a higher value, or they can expect to be paid out dividends? So this is all about the growth potential and not about um, getting a payback at a specific time like debt. And then you have joint ventures. So if you are in any kind of a partnership with a third party, you're sharing resources, you're sharing costs. They might be looking to get you to report, what is it that you spent the money on? If they gave you money and they said, we're going to pay 50% of costs. What were those costs? What is 50% of them? So checking that the costs were distributed fairly, and then whatever profits or benefits were generated from that project, that they are also shared and distributed fairly. And then you at the bottom, grants and subsidies are non-repayable funding, means you don't have to pay it back. So that's not an obligation, but they often come with a lot of reporting obligations tied to them. So grants are non-repayable funds that are tied to a goal or a project, and their reporting requirements would be to show what you have spent on. Normally, they ask you to submit a budget and then report back in terms of what it is that you spent your money on. So they want to know that, plus what was the impact that was generated. Did we help you to improve revenue? Did you hire more employees? Things like that, to see that you achieve the goal that you had set out for the project. And subsidies are, again, non-repayable, but they are focused on covering specific expenses. The most common example of this is research and development or payroll. So they're not goal-oriented like grants. Their reporting requirements are generally, if you get a payroll subsidy, they'll ask you to prove that you paid an employee before they reimburse you for whatever portion that the subsidy covers. So there would be proof of expenses.
Sorry, there are two questions in the chat. Celia's asking, if you pay independent contractors, then the payroll is not required, correct?
If you pay independent contractors, I would say you should look at the rules for issuing a T4A. For that, you could still require a payroll account to file that you have independent contractors working for you.
Perfect, got it. And Nikki has a question. I've come across limited partnerships recently as funders. What is the difference and why they have a board of directors?
Can you give me a little bit more context into what that is?
Sure, Nikki, you can also unmute yourself and
Yes, sure. Hi there, Zara. Yes, I've just learned about a client of ours, and actually they were just discussing with me all their sources of funding and how they pool money into the business. So they actually had all these things you have on the list in addition to LPs, limited partnerships. So I just wasn't really that sure about how this works from an accounting sense. And if you're not sure, that's okay. Maybe this is unique to how they've set things up, but I was just wondering if you have any insight. And they had told me that this one type of funding is where they have a board of directors sitting.
Limited as the liability.
From the board of directors or the legal side of things, I'm not that familiar. I know the term partnerships comes up in, it can mean a few different things. So what I was referring to in terms of joint venture, it can kind of fall into that bucket as well. What some people can also do is you can set up your business as partnerships, and each individual accounts for their own piece. Basically, as a sole proprietorship, you just report whatever part of the partnership you own.
Mhm.
Don't know if that might be exactly what you're referring to, though. Sorry.
No problem.
Great, thank you. And Hamsharan is asking, what about freelancers? Hamsharan, is that linked to the investment and the funding aspect
No,
for
that's only
freelancers?
like independent contractors and freelancers. Like, what if you have freelancers that you brought to build your software?
So there are parameters. There's guidance provided by the Canada Revenue Agency in terms of what is a T4 employee, what is what kind of a relationship should have a T4A attached to it, and what does not require any kind of reporting like that. What I can do is after this session, I'll follow up with Alina and I will send her the link in terms of what are the parameters that CRA has issued to help you decide if you need to issue T4A for someone or not. Generally, if they're service providers and they provide that service for a lot of different people, technically as an accountant, I'm a freelancer, and I don't get T4As.
Yeah. That's why I was curious, because I know that freelancer that like I was thinking of hiring is in India, and I'm using freelancer.com to actually. So I was just wondering, the payments I make to them, do I have to report those, or how does that work?
I'll send you the reading material, and there's a few parameters there to help you make that judgment. I think that'll be really helpful for you.
Thank you.
Okay, just a brief mention of auditors. They can always potentially be users of your accounting information and financial statements, whether you have accountants who are auditing for you, you have investors that require it, Canada Revenue Agency, if you're doing your tax filings, HST payroll filings to them, they can actually come back and tell you that they've decided to audit a part of what you filed. So for example, if they do a payroll audit, they're going to want to see those pay stubs, proof that the money went out of your bank account, all that stuff. So you want to make sure that your records are very, very clean. If, for example, you have, let's say you reported $10,000 in consultant expense, CRA decides to audit that and you don't have anything to back that up, that's something that can be rejected or removed. And that includes, providing a breakdown of what that expense is for, and even providing the actual invoice or the backup documents from the suppliers. So that's why these details are quite important to maintain. So like I mentioned here, detailed validation and transaction level review can be done with audits to make sure that the financials are accurate and legit. Okay, jumping to more fun things. So the reason you also do all this work, in addition to keeping all these stakeholders happy, is to manage your business success better as a founder and leader for your business. So when you're, this was kind of my cycle as a founder. So when you're using finance to power your business, it can generate a lot of value to the day-to-day piece for your business and how you do your strategic planning. So if you're running back and forth between wearing these two hats, I want you to use finance to rethink the process a little bit. So when you have a strategic plan, attach a budget to it that tells you, okay, here's what I plan on doing. Here are the results that I'm hoping I'll get, which is your strategic planning. And for your business, nobody knows that better than you, right? So you want to put that into a budget that can reflect your assumptions, your expectations in terms of, how much revenue you're going to get. You're going to be able to bring an investor in. And then it also outlines your costs. So how much you're expecting to spend on bringing your strategic plan to reality. And that will help you run your business day to day. It will tell you what it is that you need to spend your money on. It will tell you when if you're spending too much on one line, you got to say, okay, I got to budget somewhere else. You can plan really, really well if you come back to your budget as you're running your business to make decisions. And the budget is really similar to like if you do a business plan or a business model canvas, it's fluid. It will keep changing. It will keep evolving. And it can provide a lot of value if you maintain that with you. And then when you run your business, you want to go back and compare what actually happened to your original budget, and then review those results. There's a lot of valuable reflection that can be done here. So when you maintain your accounting records, you can export that out of the accounting system and compare it to your budget. And you can ask your questions, why was revenue lower than expected? Is it because did I give too many discounts and my average price was lower? Is it because I just didn't sell as many units? Which expense categories did I spend more on than expected? It can help you to identify things that went really, really well so that you can replicate them, and things that did not go well so you can change that. And then you can incorporate that into your strategic planning. There's things that are not working because I planned this and this is what happened. So we need to do something different. So there's so much value that can come out of this. And I want you to make sure that you're going through this process. I would say doing the results review and incorporating that back into your strategic planning quarterly, definitely quarterly. Do that. Now, I know budgeting can be a little bit overwhelming. I love this little comic strip. It really is guessing. It's educated guessing when it comes to budgeting. If that's what it feels like, that's totally fine. So, and it goes on to say, so your financial forecast turned out to be wrong. It will always be technically wrong. So your budget is really a process of guessing plus math. True story. I can help you with the math. There's templates for budgets that you can fill out. And guessing, you get better at guessing with research and with time. The more history you have in your company, the more information you have on how things work in your industry. How do your customers react? How much do your suppliers charge you? Sometimes it can be hard to estimate those things when you don't have any history. Start from research to build some good guesses and keep improving that over time. Yeah. So don't be overwhelmed if it feels like you're pulling numbers out of the dark. Definitely go through the process. So I'm going to be talking about the math a little bit. The first thing that you want to think about when you're building your forecast, of course, is revenue and pricing. Essentially, what you're trying to decide here is for your business, you have a value proposition, you have a product or service, and you have an idea in terms of why your customers will derive value from that. So when you translate that into specific amounts that are going to be going into your budget, these are all things that you thought about in your market research. Define your relationship with your customers. How much are they willing to pay you? Are you competing with other products or services? You can use that to benchmark your pricing. In addition, you want to think about what's the nature of your relationship with your customer. Is it a one-time purchase? Is it a recurring purchase? Or do they sign up and then you're getting a monthly subscription for a long term until they cancel? And you're going to be reflecting that in your revenue based on how you make estimates. For example, if you have a subscription-based model, the key questions that you're asking yourself to make estimates on is how many new customers are going to become subscribers this month? How many old subscribers are going to cancel, which is that's what churn rate is. So how many old subscribers are going to cancel? How many will maintain? Those are the kind of questions you're going to answer. With a one-time, you're going to be figuring out, okay, how many sales can I make? with recurring, there's also, you're trying to guess, okay, if someone bought something this month, how many customers are going to come back and buy it from me again in 3 months? Let's say you're selling soap. They buy it, they really like it. How many customers do you think are going to come back and buy more? How many will like it enough for that? So those are the type of guesses that you're trying to make. The questions that you ask yourself to estimate revenue are very different depending on what your pattern of collecting revenue is. And you should reflect that in your budget based on how your business model works. So after revenue, thinking about costs. To think about costs, just because it can be, there's quite a few lines in a budget and it can be a little bit overwhelming. In order to build your budget or to try to improve or update it, this is a process that I like to go through with entrepreneurs, is that what you spend money on really has to line up with your strategic objectives and goals. So I'm assuming everyone here is familiar with the business model canvas. If not, I'm sure that would be something that Alina can help you with. And that's where I've gotten the strategic objectives. So what is your goal? And these are just coming from different boxes in the business model canvas. So are you trying to get more customers, increase revenues? Are your costs too high and you want to look at decreasing them? Building partnerships, raising funds. So these are all things, what's in your business model canvas that you want to improve. And that can define your strategic objective. And then be very specific about what that looks like. So if you want to increase revenues, quantify that. Is it 10,000? Is it 50,000? Is it 10% higher than last year? And once you quantify that, you can reflect that in your budget when you prepare your budget for next term. And then I want you to ask yourself, what are the things that you need, the activities and the resources that need to happen in the organization to help you achieve that, the benchmark that you set for yourself. And this is very much, it's not very finance based. It's a very, it's more of a reflection activity, but it's designed to help you be a little bit more comfortable with the process of budgeting. So thinking through what is it that you need to achieve your goal, then the last step is just, how are you going to get connected with that resource? Is it going to cost you anything? What is it going to cost you? And then you want to reflect that in your budget. So you'll see the target, goals, and benchmark goes into your budget, and then the cost of getting the activities and resources also gets reflected in your budget. And you can run through this and have as many strategic objectives that you need. You could be working on quite a few of these at the same time if your business is growing, to be able to plan for your next level or what's going to happen in the next year. I do have one particular example just to illustrate how this works. So in this example, my strategic objective is to increase revenues. The specific benchmark that I've set for myself is that I want to have 10% more revenue than last year. So if my revenue last year was $1 million, this year I want that to be 1.1 million, and that's what I'm going to put in my budget. What are the resources that I need? So let's say I've done my strategic planning, I've done my market research, and I realized that the best way for me to get those sales is to get a new salesperson on the team. That's what I need. That's my critical activity or resource. And then for my budget, I determine that that person is going to cost me a salary of $50,000. So again, that goes into my budget. So if I'm looking at my budget this year versus next year, the difference that I'm going to see is that my sales, I'm going to increase them by 10%. And my costs, my personnel costs are going to be higher by 50,000 because I've made that plan to hire a person. So that's just a demonstration of how that works. The same goal can have different branches. So I could have increased revenues 10%. I could be doing that using having a new salesperson plus a social media campaign. So one goal or benchmark could have multiple branches in terms of activities, resources, and different kinds of expenditures to help me achieve that goal. And I can run through the goal of the exercise of thinking, what are my strategic objectives, as many times as I need to, until, you know, I make sure that all of my strategic objectives are very comprehensive and they're covered. That, you know, my goals in terms of customers, my goals in terms of innovation, in terms of the efficiency of my operations, all of those that I want to achieve within the next year are reflected in this exercise. And then, so this is what on the right hand side, these notes, that's what the budget will look like. So once you've gone through the exercise and you've identified the revenue and costs, this is a template that you're going to be putting into. And if anyone's interested, I'm happy to send you an Excel spreadsheet on a simple budgeting template that you can start with. So let me know in the chat if that's something that's of interest to anyone here. So the budget starts with revenue from products or services. And you want to articulate, very interested, good, okay, I'll send the template. So for revenue, you want to, at minimum, disclose how much you're charging and how many units of that product or service you expect to sell. I would say for revenue, do a separate budget and estimate for each different product that you have, plan separately. And then here, like we talked about earlier with your revenue planning, if you have a subscription model versus a one-time purchase, your budget should look different to reflect that. Mine is simple template for a one-time purchase, but if you need for a subscription-based model, I can help you with that as well. And then below revenue from products or services, you have the variable cost. So if you remember earlier to income statements, to the income statement, you had direct costs. So direct costs are the costs that go into producing your product or service. In the budget, you consider them in two parts. One is variable. So variable is additional costs that you incur every time you have one more unit of sale. And then you have fixed direct costs, which are the costs that don't really change depending on how many products or services that you're producing. So an example of this would be that for variable costs, let's say you produce toy cars. Every time you have to produce and sell one more toy car, you need additional screws, you need additional wheels, you need additional pieces of wood to put that together. That's your variable cost. Your fixed cost would be if you have full-time employees as production staff, that's your fixed cost. Whether you have to produce one car or 1,000 cars, you have that employee reporting to you and claiming their salary. So you want to differentiate between the two. And in the budget, what you can do is you can play around with the number of units you expect to sell, and that would be reflected. Your variable costs would go up and down as well. I have a great video that explains this concept, which I will also send as a follow-up resource for everyone here to learn more about this concept. So your fixed costs of production, they essentially help you to establish the capacity of the business. So if you're renting a production facility, if you have full-time staff that are ready to produce your products or services, you're ensuring that you have a certain capacity that you're able to produce at for your product or service. But it's hard to knock those costs down. Like you can't pay rent for half the facility if you have less demand for your product or service in a particular month. That's why their nature is fixed. I hope that makes sense. If needed, I can do another example. So revenue minus variable cost gives you your contribution margin. Your contribution margin is how much you earn profit on each additional product or service that you sell that goes towards covering all the other costs in your business, which is your fixed costs and your operating costs. So then below your contribution margin, you have the fixed costs of production. which gives you your gross profit. So gross profit, you'll remember from the income statement that that's revenue minus your direct costs. And then below that, you have your general and admin or office indirect costs, anything like that, that you need to still incur to be able to run the business. Accounting, legal, insurance, all of that stuff would go under there. And then after that, so after taking out general and admin costs, you get what's called your cash flow from operations. So this budget spreadsheet looks very similar to a cash flow statement. So the top chunk that we've just reviewed is your cash flow from operations. And then you have asset purchases, research and development expenditures, which are your cash flow from investing activities. And then at the bottom, you have your financing activities, which if you build up the rest of the budget and you see what is it that you need to invest in, it will show you, hey, you're running out of money in January. So how are you planning on funding that? Are you putting in the money yourself as a shareholder? You can put that in. Are you expecting to get a grant? Are you getting a loan from the bank? There's also room there that you can show if you need to pay debt back, you can plan for that. And then the bottom of the budget spreadsheet, it is cash based to help you monitor how much money you have cycling through the business and when you run out of money. It tracks how much cash you have left in your business at the end of every period, which for a budget spreadsheet, I recommend quarterly or monthly. I have a couple of tips in terms of putting together your budget units. So you have, when you're thinking about units for your product or service or how many you want to sell, for example, for hours worked, if you're a service provider, your unit could be 1 hour worked. Or your products are physical products. If people buy them in batches, then you can do that as 1 unit. 1 unit could be 1 ticket sale, 1 new subscriber. And that just helps you to consistently report and look at it, because let's say your KPIs are that I'm going to sell 100 units. Well, what does that look like to you? And you can make sure that you monitor it consistently for what your unit KPI is. Other things to consider when you're adding costs, think about personal costs that you're currently paying out of pocket, or just personal assets that you use for business. Factor that into the budget. I would say, like, let's say I personally prepare a budget for myself. I would just mark off in there that I'm paying that myself, so it's not going to make the business run out of money. But if I'm presenting the budget to potential investors, I want to show them that it's a real cost of doing business. For example, I'm a service provider. I use my personal laptop for work. I don't really worry too much about kind of funding it because I do use it for personal as well. So of course I would replace it, but if I'm pitching my business profitability, I would say, yes, it requires me to have a computer, and that's a legitimate cost of doing business. So I would reflect that in there. We've talked about direct versus indirect costs, variable versus fixed costs. And you can kind of get used to figuring out what's the nature of any particular cost. So direct versus indirect being, is it producing your product or service or not? And variable versus fixed being, for variable costs, they will change with the level of production of your actual product or service. Yeah, and then as you go through, if you prepare a periodic budget, let's say you do it quarterly, you should be able to kind of tells a story over time. So, is your revenue going up from Q1 to Q2? What's happening to your cost? When do you decide to hire your first employee? When do you decide to hire your second employee? When you prepare a budget over time, it does tell that story in terms of what's happening in your business, how it's growing and progressing. Just a couple of things to highlight for budgeting best practices. Report by segment. So if you have different products or services, different sales channel, let's say if you have a B2B component and a B2C component, sort of business to business and business to customer component to your business, track those separately. If you're going back and looking at your business later, you want to know which one's performing better, which one's more worth your time. It helps you to determine things like that. In certain cases, it's also helpful to be able to track by location. So having different business segments in your planning is very, very helpful. You can have different versions of your budget for internal use, for external use. For example, for internal use, I have a budget that, I play around with it. It's a very fluid document that I use to say, okay, if I spend less on this particular item, or if, I do less advertising and save that money, but that also means that I'm not able to get as many new customers. How would that affect my profitability? That's my personal version. I can play around in it. If a bank asks you for financials, you can give them a version that's more, that can reflect, okay, if you give me $10,000, here's what I'm going to do with it. Here's how I'm going to grow. So different versions for different users, different decisions. Once you set up your budget, you can even, you can play around with it to see what would be the impact of different key decisions, or to say, okay, I'm running out of money next month. I have to move some of the costs into later months. What are those going to be? Your budget can also help you manage cash flow like that. The other thing that I really like to do is called sensitivity analysis. So sensitivity analysis considers the impact of external factors on your budget. So if you plan to get 100 customers, what if you only get 75? What's going to be the impact on your budget and profitability? You can input things like that and very clearly see and predict what your profitability level is going to be. Do you run out of money? And that can be really, really helpful in contingency planning. On the right-hand side, I've just highlighted a couple of things in terms of what might be asked from the budget. So your break-even point. So your break-even point is when your contribution margin is equal to your fixed income. So you're covering all your fixed costs, and your net income is 0. So that's your break-even point. When do you start to make a profit? How many units you need to sell minimum to make a profit? So that's part of sensitivity analysis. EBITDA is a pretty standard measure that's requested by investors, and that's your earnings before interest, taxes, depreciation, and amortization, which can be derived from your income statement or budget. The other thing you have is a cash burn rate. So you can use a budget to determine how much money you're spending per month. It can be very quick and easy math sometimes to say, okay, how much on average are you spending per month? So let's say you have a spend of $5,000 per month, but you have $7,000 in the bank account. You know that you have a runway of spending of only about a month and a half before you run out of money, if you don't get any other cash in the business. So it can help you to determine things like that as well. And it's a great way to make decisions. If you're trying to decide whether you buy or rent equipment, if you want to get funding, it can help you make pricing decisions. So, what's my profitability if I charge people $10 versus my profitability if I charge people $8? You can also use it to determine if you get a bank loan today of $20,000, are you going to be able to pay that back in the future? You can use a budget to monitor your expected cash flow and estimate that you would be able to do that. So it's really, really useful to look ahead and play around with it and find these answers in your budget. That's it. This is just a summary of kind of the topics we've talked about today, going through the steps of the accounting process, and how the information is used from just compliance, your basic stakeholders, and then using the budgeting and accounting process to support your success. Yeah. Any questions?
Perfect. Yeah, I was going to say the same. So if you have any questions, you can drop them in the chat or just unmute yourself and ask your questions.
Anything on accounting, tax, budgeting?
Yep, there's a question in the chat for you, Zara.
Okay, so as a sole proprietor, if my business has no revenue in the first year, do I need to submit my taxes? Submit it at the same time as your personal taxes. Yes, so as a sole proprietor, the way you submit your taxes is, so you submit your T1 form as an individual. For the sole proprietorship, you add extra forms to your personal tax filing. It's called T2125. It asks you to report the nature of your business. So what is it that you do? And it asks you to report the revenues and expenses related to your business. If you had no revenue, yes, it is still beneficial. If you are reporting a loss on your sole proprietorship, especially if you have a part-time job or employment, the loss from your business can actually reduce your taxable income overall as a person, and you can save on taxes. So you should definitely include.
Great, thank you for that, Zara. Nikki has a question. Can you also explain the T2202 for employees and how this works and limits?
I'm going to look that up. I don't always remember the forms by name. Oh, wait, tuition and enrollment certificate.
No, Zara. Hi, Zara. Sorry. So just to let you know, I don't know if I have the name of the form right, but this is the form where employers can give to their employees to actually do write-offs for their expenses.
Yes. So you would have
Wondering
to,
what the limits are and how that all works.
yes. So your employer will, I don't remember the name of that particular tax form, but essentially what the employer does is when they fill out the form, they will describe what it is that they recognize that you have to pay out of pocket to be able to run your business. So it lists different type of costs. It will say, does the employee use a personal phone for work? If they say yes, then you can throw your phone bill in.
Yeah.
So it outlines stuff like that. And then if they've provided that for you, then you can add an additional tax form to your T1 tax filing to list all those expenses. And that's called a T777 Statement of Employment Expenses. So that when you submit, the form your employer gives you, you keep for your records in case you get audited. And the CRA asks you to provide that form as proof that you are eligible to claim all those expenses.
Okay, thanks.
Is that clarifying?
Yeah.
Perfect. Celia is asking if you register as a corporation and have a negative balance, does that have any impact?
Yes. So by a negative balance, you mean you're reporting a loss, like you have more expenses than revenue. Am I getting that right?
Yeah.
Yeah. Okay. Yes. So you should definitely report as a corporation. When you report a loss, it gets banked for future use. So as a startup, let's say this year you report $1,000 in expenses and a loss, CRA will bank that. So next year, if you have $10,000 in profit, the $1,000 will be applied against it, reducing your taxable income to $9,000. So definitely.
Okay, thank you for that. All right, any more questions in the chat? I know with finance and all the information that you've shared, Zara, it's I'm sure all the attendees are still processing it. Uh, okay, there's another. Celia's just adding on to her question, but that is only if you remain registered as a corporation in the second year of the course.
No.
You get to use the losses against future income. So your corporation has to be operating and claiming some income. Yes.
Great. All right, you guys, any more questions? This is your chance. I know with finance, it's a bit of a tricky topic, but if you have any questions, please feel free to ask now. Right, Zara, I think we're pretty much done with the questions. Right, I'm also going to share in the chat a survey form for this session, and it'll be really great if all of you can give us your opinions about this particular session and share your feedback. Right, before I let you, oh, there is a question. Perfect. Is there a way to take money from a corporation with reduced taxes?
It really depends on your specific situation. So whatever might be your optimal tax situation depends on what you have and what you claim as a person too. The one thing with the corporation that I will highlight is that if you qualify as what's called a small business or a small private corporation, it's called a CCPC. You do qualify for lower tax rates than a regular corporation if you qualify for that.
Perfect. All right, so what I'll do right now is I'm just going to quickly share my screen. If you have more questions, guys, you can put it in the chat for Zara while I quickly share my screen and tell you what we have in store. Can you see my screen? I'm not too sure if you can see the right one.
I see the schedule for.
Okay, perfect. Yeah, perfect. Yeah, so I just want to remind everyone that next week we're taking a reading week break. I will be sending all the resources and the recordings to you following this workshop. If you haven't been receiving my emails, please let me know today in the chat. I'll make sure I add your email addresses in our contact list and reach out to you personally because we do use the Whitespace inbox for all our outreach. Sometimes it just lands in the spam folder. So if that's happening with you, let me know. I can start using my personal email address to send the resources to you. The week after that, oops, wait, let me just. Yeah, there you go. The week after that, on February 28th, we have an very interesting session on setting up your business operations that our partners owner are going to facilitate, in which you can learn how to use the platform of owner to incorporate your business and when to incorporate and the entire process, including an incentive that is given to Whitespace founders. So do attend that session as well. It'll be really, really valuable to you. Right, so that was just a few things that I wanted to share. Perfect. Zara, I think this wraps up our session tonight. Thank you so much for taking out the time for this session. All your resources, the insights that you've shared with the attendees are extremely, extremely valuable. So thank you so much. We really, really appreciate all the time and effort that you put into this.